Hello, this is Doug Gerlach, Editor-in-Chief of the Dividend Informer newsletter. Today is January 14th, 2025. Today I'm joined by Miles Putnam to review investing for dividends and growth with the Dividend Informer newsletter. Thanks for turning out for our presentation as we go over the features of the newsletter and talk a little bit about our stock selection process and give you an example of a recent pick that we've included in the newsletter. There are handouts for the presentation, copies of the slides that are available in the Handouts tab in the GoToWebinar application. They're there in a couple of versions, black and white, 2 per page or 4 slides per page, but it's all the same content in each of the 4 available PDF files. As always, you can enter your questions in the questions box in that GoToWebinar application as well. We've got Russell and Sean in the back office who can also help address questions. We'll be taking a couple of breaks during the presentation to address your questions. You won't need a microphone in order to participate, so if you type your questions in that question box, you can provide the feedback that we will be able to address during the presentation. Today, joining me is Miles Putnam, who is a chartered financial analyst. He's an analyst on both the Dividend Informer and the Investor Advisory Service newsletters. He also is the author of Better Investing Magazine's Yield Signs column. He's a vice president at Provident Investment Management. And I'm your host, Doug.
Miles checking in.
There you are. Hey, Miles. How are you? And I'm Doug Gerlach. I'm the senior equity analyst at Equity Research Service and the editor-in-chief of our 3 newsletters, the Dividend Informer, the Investor Advisory Service, and the Small Cap Informer. But today we're here to talk about dividends. We're going to cover the background of the newsletter and how to use it. We'll also be addressing the investing approach and what makes it a little different from other dividend resources that you might be familiar with, talk about the company selection criteria, our scores system, and Miles will also cover one of the recent selections. And then at the end, we'll give you the typical how to subscribe and the special offer link if you're interested in following up with the newsletter. So with that, let me jump right in and start to tell you a little bit about the history of the newsletter. We officially launched it in August 2023. It was spun off, so to speak, from our Investor Advisory Service newsletter. That newsletter is a longstanding outperformer with a track record of outperforming the broader market averages over the long term. But we saw the need for alternatives to that IES total return growth approach for investors who might be ready to ease up on the throttle or might be looking for more diversified alternatives to a pure growth stock approach. And so the Dividend Informer was born from that need that was identified. We aren't a newsletter provider in that we're not providing managed portfolios or model portfolios, but really a research service. Our team of analysts are doing the deep dive into dividend stocks in order to find opportunities for individual investors. Now, Equity Research Service is our brand of newsletters under which we publish our newsletters, the 3 newsletters, the Investor Advisory Service, which has been published since 1973. Obviously, neither Miles nor I have been on board quite that long, but I've been editing that newsletter since 2003. That newsletter is one of the top performing newsletters in the country. It's been named to the Hobart Financial Digest Honor Roll for 15 consecutive years, and that's more than any other newsletter that is tracked by Hobart. The Small Cap Informer was started in 2012, again, as an alternative to the broader market cap coverage of the Investor Advisory Service, focusing on smaller companies with a long-term perspective. And that's kind of differentiates us in that marketplace. We're not a trading newsletter. We're really looking at long-term fundamental holdings. And we do have a track record of outperforming the S&P Small Cap 600 since inception. And then in 2023, we launched the income-generating Dividend Informer, which is really focused not on yield, but on reducing volatility and diversifying into quality dividend stocks. The analysis for the newsletter is provided by Provident Investment Management. This is an independent management firm in Michigan. And they have a staff of chartered financial analysts that select and present the stocks included in the newsletter. They also provide the research for the Investor Advisory Service newsletter. And that CFA designation is pretty rigorous, and it's also pretty unusual for an investment management firm to have CFAs on staff, but they've got them in boatloads of them over there at Provident, including Miles, Dan Boyle, Scott Horsberg, James Skubick. And I serve as the editor-in-chief, so we'll be working on the publication side, publishing social media, editing the newsletters, and developing the various features that we'll be talking about and deploying them for subscribers. So with that, let's talk about using the newsletter. This is a newsletter for 2025 in which it is not a printed newsletter. It's published on Substack, which is a leading platform for newsletter content these days of all sorts, including financial content. As an online newsletter, we don't publish a single issue. We are sending updates continuously throughout the month. This has been a change for some subscribers who are used to that receiving the PDF and sitting in their armchair and reading it, but it's also and so some subscribers are not fully on board with that new experience, but others like the fact that as we push content out through the month, we're not beholden to a print schedule, which means by the time subscribers receive either a PDF or a printed newsletter, the data in that newsletter might be off by 2 weeks or longer. So this provides us with the opportunity to deliver more timely content, which is one of the key advantages of this particular platform. You can read the content in your email inbox as a subscriber. You can also log into the Dividend Informer website, or if you have the Substack app, you can read the content directly in the app. You'll get an alert when new pieces are published there. You can find us at dividendinformer.substack.com or go directly to dividendinformer.com, and that will link you over to the newsletter publication. So the features of the newsletter include 1 or 2 monthly company recommendations. So here you can see some screen grabs of the stock that Miles will be talking about later on, with graphs and data and narrative to help you understand the business. These recommendations, these write-ups are typically 1,000 to 1,200 words. So we are digging deep, but not covering every single aspect of the company's fundamentals just to look smart. We're really focusing on the subset of criteria that we identify as being really most revealing about the company's prospects and understanding how the business is operated and what makes it a quality company. At least 4 times a year, we update companies, typically following the announcement of companies' earnings and quarterly results. And so those summaries meant to keep you up to speed about the particular company's progress over time. Once a month, we provide a full spreadsheet of all covered companies. This has multiple columns in it with updated buy and sell prices. It's got other metrics like PE ratios or PEG, the payout ratios for the dividends and free cash flow, debt levels, etc. That spreadsheet can be downloaded. It's a CSV file, but it can be downloaded and you can open it in Excel. And we certainly have a lot of subscribers who like getting into the numbers, digging into them, and sorting the columns by various criteria, whatever makes most sense to you in your personal approach. When necessary, we'll issue sell recommendations and discontinue coverage. And so those are also pushed out immediately when we identify that a company is not living up to its full potential. And then once a month, we provide plain English economic and market commentary, where we look at what's going on with rates and yields and what's going on with the broader market, both large cap, small cap, mid caps, etc. We'll talk about what's going on in the economy, what the inflation figures look like, and give you a sense of how they relate to a typical investor's portfolio. We are very much focused on the long term, but believe that it's good to be an informed investor no matter what your time frame is. And so that economic and market commentary is available to non-subscribers, as well as we try to make sense of everything that's going on in the market. Now, a recent feature we've added is a monthly summary of posts. This is designed for those subscribers who like the old feel of just sitting down and reading the newsletter. This summary post includes all of the updates, the market commentary, the company recommendations, the news, the upcoming dividend payments for the coming month, all in a single post, so you can sit down and read all the recent publications using that summary screen. So you can, if you're new to the newsletter, you might want to look for that published at the beginning of each month now going forward. So let me talk a little bit before we turn it over to Miles about the investing approach that we use and what makes us a little bit different. We look at the market of newsletters for investors that are focused on dividends, and we see a lot of yield chasing. We see a lot of low quality companies that might be good for a trading strategy, but really are not buy and hold positions that most investors should be taking. Also, dividend investing often is perceived as being boring or fuddy-duddy relative to growth stock investing. And that's certainly, as yields have fallen in the S&P 500, that could be something that many investors might look at dividends and say, oh, that's great, but I'm not old enough to need dividends. And we see that as being something of a misunderstanding of the role of dividends and capital return in an investing approach. Likewise, focusing on yield can be dangerous if you're chasing those very high yielding companies without an understanding that those companies are often ripe for fundamental underperformance or capital depreciation over time. That those can be problematic. So our covered stocks aim to provide an array of well-managed businesses that have good prospects for future dividend growth, in addition to some capital appreciation prospects. And that is a part of that two-pronged strategy that we'll talk a little bit more about as we go on. It's an interesting in that the analysts there at Provident consider dividend stocks as a separate sub-asset class from equities, for the broader equities. They do have different characteristics. They have different objectives within the portfolio, that if you are focused on a long-term growth-oriented approach, this is a different type of stock. The advantages of a diversified portfolios of these kinds of companies can give you some inflation protection, plus that few extra percentage points of capital appreciation. And we fully recognize that the selections in our newsletter may not exceed the market averages, but the trade-off is they may offer reduced volatility. Volatility and risk are things that individual investors often grapple with. They claim to be risk averse, but they take action when they see stocks that are tripping up fundamentally and seeing their prices decline. Then all of a sudden, all of that risk aversion goes out the window, and panic selling replaces it. So if you're worried about volatility, having some of the kinds of companies that we follow in the Dividend Informer in your portfolio can be a useful adjunct. As I mentioned earlier, we are not a high yield newsletter. Our average yield is over 3%, which is more than double the yield of the S&P 500. So is that high yield? Well, it's higher than most stocks on the S&P 500 certainly pay, but chasing after those yields that are super high can be dangerous to total returns. We're also not a growth stock newsletter. We have companies that have some growth potential. Maybe they won't exceed the market average for growing companies. But again, it comes back to what's that dialing in that right mix of volatility prevention and reduced risk, and accepting the reduced reward that comes with it. We don't provide a model portfolio in that we're not sending out calls to buy this stock, sell this stock, or here's our basket of preferred holdings. We're really building out a research list that investors at any point can come in and start the process of building out a portfolio using our selections, and you put them all together and you get something that's a little bit more finely tuned to your particular investing approach. In the questions, I see Marcus ask why we are not using the stock selection guide. If you're familiar with the stock selection guide, this is a tool developed by Better Investing to analyze company prospects and project future potential results, and that is very much a tool for analyzing growth stocks, and we are not covering growth stocks in the Dividend Informer, so the SSG it's the wrong tool for the job. You can certainly there's certainly overlap in the Venn diagram of SSG stocks and non-SSG stocks. There's certainly some overlap with the companies that we cover, but often the companies that we are covering in the Dividend Informer wouldn't meet our stock selection guide based total return, again, based on any individual's personalized approach that may or may not be acceptable. So it's really, we're trying to explain how the approach is different from that total return growth driven approach that's used in the stock selection guide. So thank you for the question. And feel free to type in your additional questions in the questions box. But I'm going to turn it over now to Miles, who's going to talk about our approach to company selection. So good morning, Miles. Hello. Thanks for joining us. And please tell us what makes the Dividend Informer different.
Yeah, well, thank you, Doug. And that was a great introduction to just what the newsletter is, both the logistics of it and to some extent the motivation behind it in the first place, which I guess is where I would like to start as well. When you come to dividend stocks as a tool to serve your own financial needs, there's the question of, okay, well, what do we want them to do for us? And then how do we find the stocks that can do that job? Usually the job that we want dividend stocks to do for us is not just to provide the cash flow of the dividends themselves. Usually what we want, and certainly as at Provident here in our day jobs, what we're looking for our clients' portfolio are dividend stocks that we think can be kind of a steady bedrock of a portfolio, the types of companies that in a really pronounced or prolonged bear market would hold up a lot better than maybe some of the market leaders did. So when you're looking for companies like that, one of the worst things that you can do is go out and grab the highest yielding stocks you find in the market. But those are going to be, in many cases, what people turn to first when they think of dividend stocks, because, hey, I know how to run a stock screener, and so you screen on dividends and you just kind of start at the top and go down. Well, if you do that, you're going to basically do the opposite of what I was talking about in the first place. You're going to find a lot of companies that have unsustainably high yields, or sometimes companies that are sort of eating their seed corn. That's absolutely what we don't want to do. We want to have a dividend research service here that puts quality first. In a sense, stability first, but it's a type of stability that also includes room to grow. We're a little bit growth oriented, probably relative to other dividend products out there, but we're much less growth oriented than, say, the Better Investing strategy that people on this webcast might be familiar with. That gets into point two. You're just not going to get the type of EPS growth with these companies that you're going to get with your standard fare Better Investing growth strategy, and that's the strategy that we're pursuing with the IAS, and I know Small Cap Informer tilts that way as well. The The value disciplines is just based on, okay, where are things trading relative to historical averages? There are lots of times when it would make sense to pay more than the historical average for the company based on market conditions and just how well the company is doing. But we use kind of historical averages as, just a baseline. And then the last point on this slide is the fact that dividends aren't everything. Room for capital return through share buybacks, through profit growth, and through debt reduction are also very legitimate ways to repay the dividend investors. So yield, not quite first, important, but really quality first. So we move on to the next slide. We dig down a little bit into specifically what is required of companies to for us to get interested in them. Debt levels can't be too high. You want to see basically smart decisions by management, right? You want that kind of classic shareholder friendly, treating the shareholders as the owners, right? Not treating themselves as the owners as far as management's concerned. And moving down to the bottom, let's just have a short thought about what happens to a company throughout its entire life cycle, right? A company starts as basically an idea, then it becomes a piece of paper, and then it has operations that hopefully grow over time. Eventually, a company will grow into its opportunity, and now you become like the dog that caught the car sometimes. It's the question of, okay, what do we do with it now? And it varies a lot company by company, but the best mature businesses, once they get there, will kind of turn around and start to repay the investors who carried them along the way. That's what we're looking for, is for management teams and businesses who can do that in a kind of an elevated sense. So like I say, relative to growth investing, we're tilting more toward mature businesses. There's a range in our coverage list already, and that coverage list will expand over time. We have some businesses that are extremely mature, like so mature that we don't really think they can even keep up with GDP growth, but we like them for other reasons. We have some companies that are a little bit closer to their growth phase still, and are maybe just starting to make that turn toward shareholder return. I spoke briefly before, and you see again kind of the three legs of the stool of shareholder returns, which are in this case dividend, share buybacks, and debt reduction. Reinvesting for growth isn't really shareholder return. I kind of misspoke earlier, as if it were. What it is it's enabling the company to thrive and do more of these 3 points on the screen in the future. Okay, what's our next slide look like here? Now I don't know if we want to pause for questions. I guess I should just keep going here. Let's get into what the scores are and how we score the companies based on the 4 categories here. So we're going to assign letter grades, just like when you were in school, A, B, C, D. You can't totally flunk, or else you don't even get to be in the newsletter. And it's going to be across these 4 categories. Capital return, how much money is coming back to the investors? Is the company growing, is number 2. How stable do we think the company is, both in terms of its own capital structure and dovetailing with that, its economic cyclicality, and finally the governance. And we'll go through these point by point, starting with capital return. I won't read the whole slide verbatim, but this is, we put this first because it's kind of the main thing, right? We're investing for some kind of direct, well-defined return. And you should be seeing it certainly in the cash flow, probably that cash flow translating to dividends. If not dividends, definitely a lot of stock repurchase and debt reduction. If you don't have that, then the company might have other virtues, but it doesn't belong in this newsletter. Moving on to the next piece, growth. A lot of dividend research processes wouldn't really consider growth because, again, that's sort of in the rearview mirror when a company gets to this more mature phase. We look pretty carefully at this because we still have a lot of respect for the importance of relatively small delineations between, hey, is this like about a GDP grower? Is it a sub GDP grower, or is there still some gas in the tank for this company to, maybe double its earnings over the next 20 years, adjusted for inflation? Which doesn't sound like much, but really, if you can get that with some shareholder return on the other side, really should create a stock pick that outperforms the overall market. That works the other way too. Companies that are growing sub GDP, like say maybe just barely keeping up with inflation, well, you'd better have some real saving graces in the other scores, because that's, it's a company that's kind of living on borrowed time, right? And you just never know whether it's going to bounce back from the next recession. Moving on to stability. So, how solid is the bedrock here? Balance sheet plays a big role in our grading of a company's stability. As I said before, so does economic cyclicality. The company's place within its market matters. This is kind of the classic moat, right? And discussions around moat I find to be a bit circular, right? Because when companies are doing well, they have great moats, and then they're not doing well on the way out. Where did the moat go? But it's a real thing. Some companies just have better competitive situations than others, and it's certainly something you want to think of, because those competitive advantages or disadvantages, they have a lot of inertia. They do tend to maintain. Finally, governance is our last slide here. And this is, I was joking to Doug earlier in preparation for this webcast, governance it's kind of the most vibes based of the 4 letter grades. The way that I grade governance is I basically start with an A grade, and then will decrement for any types of negative flags. As you start to get down to the very low grades, which can happen in the newsletter, again, there must be something else about the company that you really, really like, because it's tough to go to war here with, led by business leaders who don't have your best interests first. It works the other way too. A really good management team can, sometimes just spin gold out of straw. And so we might give them accommodations in other areas. That's kind of my piece on the letter grades. I don't know if any questions have accumulated.
Yes, thanks, Miles. It struck me as we were looking at the scores, and we had talked earlier that it's not required that all companies have straight A's across the board, or even straight B's. And there's often a trade-off between a company that outperforms on one score and maybe needs some improvement on another score, and it won't be eliminated from consideration.
Yeah, that's absolutely right. I mean, if you're going to grade everything straight A's, what's the point in the first place? There's some sort of natural offset also between these grades. For example, capital return has some negative correlation with growth, just in the sense that you tend to get higher valuations with growing companies, and the higher the valuation, the lower the earnings yield, which means the less money there is to then return to shareholders through various means.
Freddie asks if there's a maximum percentage of debt that you look for.
Well, it has to be situational. It's a good question. The kind of the classic bar that you hear across the market, and one that we will often invoke in the newsletter, just kind of offhand, is a 3 times debt to EBITDA ratio. So the EBITDA being basically a cash flow metric. So the idea there is, could you in a pinch just start to use all of your cash flow to pay down your debt, sort of as needed, and within a few years be, more or less debt free? That's kind of the theory behind that. There are certain special cases where much higher debt ratios are reasonable. When you get into some of the more cyclical businesses that we follow, then EBITDA starts to jump all over the place. And so you really have to grade the debt to EBITDA relative to where you think the company is in the market cycle. You don't want to see a company that's trading at 2x EBITDA and think that that's just absolutely safe. They could add 50% more debt again and be fine, but then find out that you were grading it based on peak EBITDA, have EBITDA fall by half, and all of a sudden that 2x EBITDA becomes a 4x EBITDA, and the company looks really dicey. So there's a lot to think about, but we do kind of pay homage to the classic rule that 3x EBITDA is a little too highly leveraged.
Yeah, my observation is that a lot of the companies that are included in the coverage list might have debt levels that are higher than you would consider to be pragmatic for a growth-oriented business. But again, many of these companies are past that explosive or aggressive growth stage of their life cycle. They're maturing, and their use of capital is best served by paying out dividends and managing their debt load prudently by keeping their cost of capital low. Certainly, also I think you have to acknowledge that the debt levels vary significantly by industry, and a lot of the companies we're tracking in the newsletter are in industries that have typically carry more debt than a lot of the growth-oriented businesses that we would find elsewhere.
Yeah, that's well said.
Don asks if there are many stocks that overlap with the investor advisory service.
Almost none now. One thing that we have done is migrate stocks over from the investor advisory service into Dividend Informer. Our coverage list in the investor advisory service had become a little bit saddled with kind of past successes. And we still thought they were above market performers, but they weren't really growth newsletter material. So we didn't know what to do with them. We felt bad sort of cutting them entirely, but we also realized that they just had kind of had their day. And a few of those have now migrated over to Dividend Informer. But there aren't very many. I mean, I say very many. There might be one or two that are still covered in both, but our plan going forward is to try not to have double coverage for hardly any names.
Well, speaking of company names, why don't you walk us through your analysis of one of our recent stock picks?
Yeah, this is a fun one. It's Vail Resorts. They own 40-something ski resorts around the world, including some of the largest in Canada and the US. They own a few in Australia, so they have a little bit of Southern Hemisphere winter, right? Northern Hemisphere summer business. But for the most part, it's kind of like a live for Christmas type of retail business where they just make all their money in the Northern Hemisphere winter. What's appealing about, well, one of the things that's appealing about Vail Resorts is they just own a lot of absolutely first-class assets. I mean, these just, really nicely upgraded mountains that if they didn't own them, people would be on their own finding ways to get in there and ski, because the conditions and just the ambiance are so attractive. It's a company that has really leaned into growth by taking on a fair bit of debt, probably at levels that would turn some people off. I think it would probably fail a lot of people's screens because the debt load is high. But as we say here, we think it's manageable. It gets lumped in with like casino companies sometimes on screens. I wouldn't want to own a casino with this balance sheet, but I think that for Vail Resorts, I think it's perfectly, like I said, perfectly manageable. I use that word again. And they pay a nice dividend. They are in it for their shareholders. And a dividend is a bond, right? It's a bond between the company and the owners of the company that as long as we can, we're going to keep paying you for capitalizing us. Vail has taken that very seriously. As we go to the next slide, you can look at some of the metrics just behind that. See, it's yielding about 5%. The debt to EBITDA kind of in that 3 range, just slightly poking up above it as of whenever these numbers were struck, I guess in September. Like that's why I think it would flunk a lot of screens, but in this case, I think the assets that stand behind that debt and just the regularity with which people will keep coming back makes that debt load, totally supportable. You can see on the right side that we picked it up, I should say, introduced it to the newsletter at a pretty serious discount to its historical valuation. Sometimes valuations will just compress as companies get more mature, but we did try to catch this one at kind of a bargain price. Now we'll see what the future brings. It's up a little bit since we put it into the newsletter, and I think if it snows and then people turn out, it'll do fine. Moving on to historical fundamentals. There was that question about the SSG earlier, and we do present some of the company's financials over time in the newsletter in a way that would be somewhat familiar to people who are accustomed to using stock selection guides. That's the graphic on the right. What we will do as analysts is we'll kind of toggle these different metrics to try to paint the picture of, okay, how's the company done financially over time, and what has that meant for shareholders? So you have to squint a little bit and understand what each darn line means, but what you see, at the bottom is kind of sales just drifting up over time. And as you move up to the pink line, you can see that, I guess no surprise, free cash flow per share has drifted up as well, but with significantly more volatility than sales. That's to be expected. You can see EPS more volatile still. Again, that's to be expected. And then you see in the dividend, except for being cut for the COVID period there, you can see the nice upward trend, and the shares outstanding line has been mostly flat with a kind of a slight downward bias, and that's pretty darn good. One thing you don't want to see is you don't want to see a company that looks like it's growing gangbusters and supporting its dividend by just issuing shares, just robbing Peter to pay Paul. So diluting its shareholders, but then turning around and paying them the money they're making by diluting the stock. It's not that uncommon out in the market to see that kind of profile, and it's a profile that we, for the most part, would find really unattractive. Moving on to how I graded the company, I think I was just really kind of smitten with that nice dividend. We don't have very many names in the newsletter that pay one that's that high or has grown kind of steadily over time. And I just really like their capital return overall. They've acquired some assets, but they've been able to do it without growing the share count, which I'm impressed by, because often even very capital return focused companies will decide to they'll kind of suspend their rules in order to make some big acquisition, but Vail's denied themselves that temptation. Growth has been good, that B grade, so I would say definitely should grow in line with, if not a little faster than nominal GDP. Nominal GDP is not that low a bar, right? Start with inflation, tack on the 2%-ish numbers that you see quoted, and you're getting up into the kind of mid-single digits, and I would think that Vail should do consistently I don't know how consistently, but pretty consistently better than that. Stability, B with kind of a negative aspect to it. Maybe if they were to have a bad year here, that debt load might become a little bit burdensome. But what I like is that the assets are just so high quality that skiers will keep coming back. If there's snow on the mountains, or if it's just cold enough to be able to manufacture some snow, they'll be able to sell tickets. Governance, I gave him an A. I was a little bit surprised looking back at this write-up that I had given Vail an A. I think there were just no red flags, and when you kind of scrutinize the governance structure from a number of different angles and nothing annoys you, you just have to shrug and say, okay, well, I guess that's about as good as it gets. It's a young management team. It's a very aggressive, gung-ho management team relative to the kind of the maturity of the ski industry overall. So there's a possibility that it won't live up to that governance grade, but I liked it, and I was assigning the grade, so it got a high one. That's a synopsis of the Vail Resorts write-up that I guess I did in September. You saw kind of cartoon pictures before of what the actual substance of a company write-up would look like.
Miles,
Yes.
Ron has a question specifically about Vail, if the recent strike by ski lift operators is impacting the company, and I wondered also if you might want to talk a little bit about the weather and how it impacts Vail's
Yeah,
prospects and results over time.
it's a good question. So the labor actions will definitely affect them. We'll find out how drastically when they report their next quarter. If you're going to have a labor action like this, the time to strike is during the high season, and that's so. What their response will be, I'm not sure. Part of the charm of some of these dividend stocks is that you don't have to live as much kind of quarter to quarter and day to day with whether the kind of the derivative of the growth rate is turning up or down. And so a little bit of a negative aspect over that doesn't really move the needle for me regarding whether this is like a long-term dividend holding relative to this price, although I was as a shareholder a little bit annoyed to see that in the news. The weather is just as, if not more interesting. They had crummy weather last year. They either had no snow and it was too warm to manufacture any, or they had so much snow that nobody could get to some of their resorts out in the West. And we're getting into the nitty gritty a bit, but the company relies on a lot of pre-sold lift passes for the next season. And so it's nice because they normally would come into the high season already with quite a bit of revenue in pocket. But the problem is if nobody shows up one year, nobody buys tickets for the coming year. And so it will be a high leverage quarter here that they report. I mean, I would not be at all shocked to see the stock up or down. I'll make up a number, 15% on their next quarterly report, which is a lot for a dividend company. But if you get the up 15%, great. If you get the down 15%, you kind of have to shrug and lean on that higher quality profile that got me interested in it in the first place.
Ray asks, our comments that 5% is nice, but he's more interested in how the dividend grows over time, keeping up or outpacing inflation, and Vail may be a little problematic in that regard.
Yeah, I couldn't really tell you what their dividend policy is going to be going forward. It's, historically grown at, I think about a inflation type of rate. They could grow it faster if they wanted to stop acquiring assets, and possibly they should. We'll just see what the future brings. That's a nice transition to the question of growing dividends versus high dividends. There's a strategy out there called the Dividend Aristocrats, which is all about growing dividends over time and really to the total exclusion of how high that dividend is. That strategy, the Dividend Aristocrat strategy, is one that's pretty well known, well defined. If you haven't heard of it, Google it, you'll find a dozen really good articles on what it is. There are ETFs that are just like Dividend Aristocrats ETFs. That strategy overall is probably about as similar as you're going to find in the market to what we're doing here. It's probably a little more growth oriented than what we're doing here. And the yield generally would be a little bit lower than what we're trying to do here, but it's, you're really getting right at kind of the, like, where are the edges of this strategy versus that strategy versus a different strategy. And I'll tell you what, if you want to lean more into growth, which I can totally understand, you just maybe look for companies in the newsletter that have a little bit lower capital return grade, but maybe an A grade for growth.
I think when you look at Vail, also you have to keep in mind that because of the dividend cuts or pause, we should say, during the pandemic, I think the growth rates for the dividend are a little harder to. It's not like they were one of the aristocrats there every year. They increase it a little bit, a little bit, a little bit. They're coming from a couple of years. What was it, 2 years where the dividend was cut or reduced or eliminated. When I look at the most recent metrics here, it looks like this year or last year they raised the dividend 7.5% over the prior year. So that long-term 5% growth of dividends over the last 5 years is probably undershooting what the company may actually deliver going forward. Would you take issue with that conclusion?
No, I think that's very plausible. That's probably about what I would expect would be for the dividend to more or less keep up with earnings growth. And I think I think I said before that I thought it could be a GDP to plus GDP type of grower in that regard. But they don't have, which some companies have, but Vail does not, a well-articulated dividend policy. We will always return at least half of cash flow or something like that. They don't do that.
Right. So it looks like there's, again, but it's not all about it's not all about the dividend. So there's a little capital, a total return component to it as well, from where we sit right now. And
Yeah,
what is that?
and long term, right? Those are one and the same because, well, you get it.
I'm just looking at the January spreadsheet where everything was recalculated. Yeah, and you're targeting 17% projected total return, 17% a year. 5-6% of that in dividends plus then capital appreciation. Partly because my take on Vail is it's more of a value. There's a little bit of a value component because of the fact that the shares have been beaten down so much.
Yeah, we got a little bit spicy trying to kind of catch a bottom, in a stock, which we don't always try to do. Sometimes we just want to pay like a fair price, but this is one that when we happen to be looking for companies to introduce, it was already on our kind of the periphery of our radar, and the stock had been beaten up so much that we thought, this thing could really work. Why don't we show it to subscribers? And maybe they'll catch a good company at a really good price.
Let me just roll with one more question from Greg about the approach. He wonders if you sometimes recommend any BDCs, business development companies, or closed-end funds.
So we've never even talked about a closed-end fund. BDCs, we've talked about one or two. Have never gotten one across the goal line. There's a couple of interesting ones in my opinion. I would like to see us add one to the coverage list, but it hasn't happened yet. And you'll never see more than one or maybe two in the list.
Yeah, we've covered in the small cap informer. We've covered a couple of smaller BDCs. Closed-end funds are problematic because the approach is structured for analyzing stocks, and the minute that you've got a portfolio of stocks, then how you measure the metrics gets completely confusing. But we have covered them in the small cap, our small cap newsletter, which interestingly, the dividend paying small cap companies is kind of an interesting niche in small company stock investing because they're already undervalued relative to large cap stocks. Everyone knows how small caps are trailing. So the yield doesn't really move a lot with the demand on the stock quite as much as it does with some larger companies. In other words, when you buy stocks, you often can get a better yield from smaller companies. It doesn't fluctuate quite as much. It's an interesting little side note there that I wanted to throw in. I don't know if you have any observations on small, mid, large relative to the particular approach. I think it skews towards large to mega cap, to be sure, but there's also some mid-sized and smaller companies on the roster as well.
Yeah, we want there to be a diversity for sure. You know, you used the term niche in the sense of kind of a coverage list, and I'd use it in another sense of a business niche. You do get these funny companies that have grown into their opportunity, and the opportunity is just not that large. And you know, sometimes the right thing to do is just to be happy as a big fish in a small pond and turn around and start paying it back to your shareholders. Too many companies think that they can make it in a small market, and that then is going to be their platform for success in a much larger, more competitive market. But when you find companies that are basically satisfied, you know, as a leader in a space that's too small for big players, but they're sort of too dominant to be, you know, shaken as the leader. Those can be very good dividend stocks. I think they require more research, and therefore it's harder to put them in the newsletter. But we do have some that I would say meet that kind of profile.
Yeah, the three newsletters do share an approach to growth stocks and long-term holdings. On the small cap side, we skew towards more on the value side. So we do have some of those smaller, slower growers who are growing at a steady pace and have the potential, you know, with the market's devaluation of small caps to deliver that rate of return that we're desiring over the longer term. What about real estate investment trusts? We have a couple of them that are being covered. But there's only one or two that's, you know, like the traditional real estate operator. Things like Lamar Advertising is a REIT, but it's not a real estate company per se.
Yeah, man, it would be easy to fill up on REITs, you know, in a dividend newsletter. We don't totally avoid the classic like real estate REITs, the ones that are going to move with basically the housing market, but we want to be very selective. And then on the other hand, we want to be, you know, quite creative in looking for, you know, REITs that might be moving on different cycles and therefore provide both nice yield and nice portfolio diversification. Yes, like a Lamar Advertising is, it's certainly somewhat cyclical, but it's on a different cycle generally than your typical down the middle plain vanilla real estate investment trust.
I was under the impression that Vail was a real estate investment trust until you cleared that up for me.
It's similar, and they've even had talks about whether they ought to become one, but it's
Yeah,
not.
there's often an expense when you make that conversion. Um, do you have you observed differences from an investor's perspective between REITs and real estate companies that are not REITs?
I don't think I understand the question from an investor's perspective.
Yeah, while you're doing the analysis, you know, if you look at real estate companies, by and large, they're going to be a real estate investment trust. Is there anything different about a real estate company that's not set up in that trust format with that mandatory dividend payout and you know, the focus on distributing the net income levels?
So I can't really. It's an interesting question. Yeah. So like there was this move. I touched on casino stocks earlier, right? There was this move, I don't know, 10 years ago or so, 20, time flies, to start to separate the operating aspect of the casino from the real estate aspect of the
Hmm.
casino.
Hmm.
And for those two pieces to trade separately, that's been an interesting market development. And I think we do follow or are soon to introduce one of the casino real estate investment trusts. I think one is in there now, but I could be wrong. I don't have the coverage list in front of me.
Uh,
Um,
is
well,
that Vici
yeah, it's Vici. I
property?
wasn't going
Yeah.
to tip it if it wasn't already in.
Yeah.
And so that, I mean, that can be a very clever, bit of financial engineering. Now, what it means for investors, it means you got to know what you're buying. You have to know
Yeah.
what Vici moves on, which is totally separate from what like CZR shares move on.
Yeah.
And then what I was really touching on before was the fact that a lot of quote unquote real estate investment trusts aren't driven by the real estate cycle. They're actually driven by different, cycles in the market. They're just almost kind of accidentally called real estate investment trusts.
Yeah. One last question about Vail. Matt asks what factors based on its industry would cause you to issue a sell notice.
So the biggest thing that worries me about Vail specifically is I see them getting into some markets where they think there's a lot of potential, but things are unproven. They've bought two assets in Switzerland recently, and they've been talking about maybe trying to buy assets in or around Japan. And my concern would be that they are maybe over optimistic, buy some assets that aren't what they think they are, and a already marginal debt profile becomes really unattractive. You just have to judge them by the numbers that they report, not really listen to management's over optimism going into a deal, but also not be a total Eeyore and just think that nothing's ever going to work. They should just shut down their worst 10% of resorts and never buy another one and just be all capital return.
Yeah. All right. Well, let's go ahead and wrap up our presentation. We've got a couple of minutes left. Our current coverage list, Miles has been talking about it. We talked about mentioned some other companies. There are 37 companies on the list right now. We're adding 1 to 2. We're adding 2. We'll be adding 2 new stocks each month for the rest of 2025, more or less, to get us to a real a very attractive, diversified selection of companies across a number of sectors and industries. So if you're looking to build a portfolio and you want to diversify by sector and industry, you can really figure it out. A lot of dividend investors will just buy 10 banks and 10 oil companies and call it a portfolio. And we think that portfolio management is something that requires a little more insight and attention rather than collecting a random selection of companies, even if they're paying high yields. That could be pretty disastrous for your overall returns if something were to go wrong with one of those sectors or industries or the broader economy. As of earlier this month, here are some of the averages for the companies. The average yield is 3.8%. That's more than 3 times the current yield of the S&P 500. The estimated earnings growth on average, 8.4%. Again, if you're using the stock selection guide, that's a very minimal growth rate for a total return approach driven by growth stocks. The 5-year historical dividend growth rate, though, is 10.5%. So these are companies that are raising their dividends over time. The average dividend payout ratio, 54.9%. Often the rule of thumb, the growth stock investors look to is making sure that dividend payout isn't greater than 50%. So here it would be higher, but again, this is a dividend-centric approach, so that would be suitable. And then the P ratio, 15.9 on average. That's a forward PE ratio times, not 2024, but 2025 estimated earnings. at this point, and that's, compared to the broader market. The S&P 500's PE right now is something like 27, so significantly less priced at a premium than the broader market, which means that a lot of these companies are going to be attractive right now. If you're interested in the newsletter, if you're not signed up to follow the newsletter, you can follow for free. That way you'll get the monthly commentary, you'll get educational articles and previews of company recommendations. And then you can also upgrade to a paid subscription. You can either subscribe by month to month, or you can subscribe, get a little bit of a discount on an annual subscription. Our charter rate is still active, and that's available to anybody who visits the website at this point. That's our best publicly available subscription rate. So when you go to the website, Substack has this all programmed, so it will point you to that sign-up page where you can select the free offering if you want to get a taste of it, or you can go ahead and become a subscriber, and there are a couple of levels there. Well, with that, we are right at the end of our appointed hour. So thank you, Miles, for joining us. Thank you all for attending the presentation. If you do have any questions, you can reach out to us on the Dividend Informer website. There are mechanisms for feedback there, contact us forms. So feel free to give us an email, drop us a message. If you have any questions about the coverage, about our approach, if it makes sense to you, if you're interested in subscribing. Thanks to Russell and Sean, who've been helping out in the back office. We'll wish you all the very best for you and your portfolios in 2025, and hopefully we'll see you over on the Dividend Informer website. With that, thanks once again. We'll see you at our next presentation.